Mike, this is the time of year this video series was made for. This is Outlook season. We work together as a team to actually allocate client portfolios, and we want to give our viewers out there a little snippet.
The real deal. Insights from the investment committee.
What are the most attractive asset classes out there?
Yeah.
Hello and welcome to the Outlook by STRAT. Figured we'd go through with our viewers the our investment framework and what drives our outlook for various asset classes. And of course, that starts with the macro. What's important on the macro side and how do we think about that?
Yep. Everything that is going to be written in any 2025 outlook, we think about and we run it through what is the impact it could have on liquidity, the growth rate of the money supply, inflation, change in the price level, real economic growth, or a recession. And we forecast each of these things out at least 12 months in advance, how they're likely to play out, high or low, rising or falling, how high, how low, how rising, how falling, impact what we think about various areas of financial markets, what asset classes, what areas of markets look attractive or unattractive. Yeah, so that's what we're doing.
Yeah, and should note a relatively high level of uncertainty around the macro environment going into 2025 with President Trump returning to the White House, one of the less predictable presidents we've had in recent history, as well as the Fed starting their cut cycle and how fiscal policy is going to impact that. So let's start with economic growth. What's the story here?
Story is economic momentum has recovered from the summer low. The weakness in the labor market we saw this summer scared the Fed into 75 basis points worth of rate cuts. And we think, left to its own devices, the economy would naturally accelerate into 2025 due to those rate cuts, due to the labor market being more resilient than expected. Now we're tacking on to that the fact that businesses are front-running tariffs. Businesses are going out saying, what do I need from an import perspective? If I need it, I'm buying it now.
Buy it now.
That's going to be an inventory stocking. That's going to artificially boost growth in Q4. So that's the backdrop heading into 2025. Once we get into 2025, we think economic growth will naturally slow for a number of reasons. One, that inventory stocking you're getting now is going to turn into an inventory draw, and that's naturally going to slow the GDP growth number. Two, you're going to get tariffs start to get enacted. That's going to increase uncertainty. There'll be a shock and awe there. And the hope is, can we get through the first half of the year and all that policy uncertainty to the second half of the year, where we think economic growth will re-accelerate again for a few reasons. One, that's been the post-COVID seasonal pattern. There's some residual seasonality there. Two, the initial shock of tariffs will fade and be replaced by excitement over tax cuts. Although these tax cuts that are likely to be enacted won't get implemented until 2026, businesses are going to front-run those. And we think it's likely that Congress has tax cuts finalized through the budget reconciliation process prior to the August recess. So first half will be tough. Good momentum heading into the year. First half might be tough. Second half looks pretty solid. All in all, that equates to about a 1.8% real GDP growth forecast for 2025. That's very acceptable for financial markets.
Yeah, absolutely. Yeah, and so yeah, acceptable, not exceptional on the economic growth front. Inflation, obviously, was front of mind for a lot of 2024. We saw some incredible progress on the inflation front, but really saw that progress start to stall out here late in the year.
Yep. Yeah, the progress stalled out towards the end of 2024 due to base effects and other factors. Unfortunately for the Fed, if tariffs are enacted shortly after President Trump comes into the White House, that is going to derail the progress, a lot of the progress they've been making recently. If we work out the math and we assume the average cost of U.S. imports increases by 4 to 5%, which is sort of a moderate expectations for tariffs being enacted and retaliated, that would result in a one-time boost to the price level, core price level, of something like 0.3 to 0.5%. That doesn't seem like a lot, but that is enough to almost completely eliminate the probability that the Fed gets core PCE inflation down to their 2% target in 2025. It also is enough to flip our forecast, which previously was for high and falling inflation, which markets generally like, to something that you see here now, which is more like high and sideways or high and rising inflation, which markets certainly like less.
Yeah. Yeah, absolutely. And the timing and the reciprocation of those tariffs is going to be a big factor, right?
Yes.
Because if they're one and done, the Fed, and we'll get to liquidity in a second, the Fed will be more easily able to look through them, right, and adjust accordingly. But from a liquidity standpoint, again, a lot of improvement starting from a low point in 2023, a lot of improvement in 2024, but similar to that inflation forecast, kind of sideways.
Yeah. We're still in a low and rising liquidity environment heading into 2025, which is the most favorable liquidity environment for equities. As we head into 2025, Jerome Powell has come out and said that the Fed does not assume they're not going to, I forget the exact quote. Do you have the quote in front of you?
We don't guess, we don't speculate, we don't assume.
Yeah. See, I don't remember the quote because it's simply not true.
Right.
He's saying that they're not going to start to forecast these Trump 2.0 policies and have them factor into their decision-making for monetary policy. And that is obviously not true.
Only businesses operating in the real economy can do that, right?
Right.
The Fed has to wait until they're implemented.
Right. So the Fed is doing scenario analysis, stress testing, thinking about tax cuts, tighter immigration, tariffs, how they're going to impact the economy, inflation, and labor markets. And they're talking about all that right now. And through all that rigorous stress testing and academic wisdom, the conclusion in our view is they're still going to cut. It doesn't change the path of rates from here, but it will be a slower pace with fewer cuts than there otherwise would be. So what does that mean specifically? Our view is we get a cut in December, then a change in messaging and tone, a cut in March of 2025, and perhaps one more cut in June, wrapping up this cutting cycle at a terminal Fed funds rate of 3.75 to 4%, which seems disappointing. But along that timeline, they're also going to be saying, well, the long-term neutral rate is higher than we thought.
Yep.
So the fact that we didn't cut all the way down to 3%, don't be disappointed by that. And so they'll be coming at it from multiple angles.
We're not as restrictive as we previously thought.
Exactly. So 3 cuts from here, 2 in 2025, that could be deemed as kind of disappointing by markets. That's actually in line with what we were thinking before the election. And the other important thing to note is markets will probably find that acceptable as long as the Fed is still ready to cut more aggressively if there's weakness in the labor market or the economy.
Right.
A Fed put. As long as the Fed puts on, they'll accept this liquidity outlook. And we think it is.
We have reason to believe that still exists, certainly.
Yep.
A scenario where the Fed put would likely need to be enacted, right? A recession. So checking in on our recession signal, still not active. Yield curve signal remains the only sub-signal that is active, but that continues to move in the right direction. Mike, this is pretty clean. A lot of black numbers here, not a whole lot of red or even the gold or yellow we've seen throughout 2024.
I mean, yeah, we've gotten to the cleanest recession signal we've had since 2021.
Yeah.
Really, or early 2022. So you look at that and you think, nice starting point heading into 2025, recession risk low. You add into that what you just said, the Fed seems ready and willing to cut more aggressively if necessary. That reduces recession probability. And then finally, if the fiscal deficit is going to be expanding, it's very hard, or it's much harder for a recession to happen. So all those things together, our outlook is that a recession seems, a naturally occurring recession in 2025 seems highly unlikely.
Yeah. So you take all 4 of these factors, you blend them all together, and we get an overall macro factor for the various asset classes. We just noted recession looks pretty unlikely. Economic growth and liquidity, not great, but not going to be disappointing anybody. Inflation, really the tough spot, flipping into that high and rising scenario. You meld all of that together and you get kind of a ho-hum macro factor, right around 50th percentile in terms of history.
Yeah, this macro environment for U.S. large cap stocks like the S&P 500, very benign. And if we look at this and we say, well, what if tariffs aren't as bad as threatened and there isn't as big of an inflationary impact? That would improve the only negative on the board. And also, if that were to happen, the Fed might be able to cut more. That would improve liquidity and perhaps even improve economic growth. So you see how this could shake out, where the macro factor starts to improve throughout the year.
Yep.
It could go the other way too, but understanding that that's sort of the art of the deal. Things that have been said, maybe these tariff threats are just that, they're threats for negotiations, and they get watered down. That would be a positive, and you could see how that would flow right through to our framework.
Yep. Yeah. And now all of the different asset classes, experience this macro environment in different ways, but by and large, the macro environment is the macro environment. Yep. The biggest driver in the different levels of attractiveness across the asset classes is the valuation factor. Mm-hmm. And so what are we looking at here from a U.S. large cap standpoint?
Everybody's trying to forecast the same macro outlook, right? So how much of that is already priced in, because markets are supposed to be efficient. So you start to build up our valuation factor for U.S. large cap stocks, a very strong long-term trend that's only gotten stronger here recently. Yep. Unfortunately, a lot of the good news is already priced in. You see that in U.S. large caps being well above their long-term trend. They're expensive. So that's weighing on the valuation factor right now. Thankfully, there's good momentum to partially offset. And then finally, you take out your expected return on cash to get your valuation factor of 5%. That's slightly on the expensive side. Not dot-com bubble-like expensiveness, and it doesn't mean the whole year is lost. It doesn't mean all the potential good news is priced in, because once again, you think about the sensitivity here. Well, what if, for example, the Fed is able to cut quicker and that cash return goes down? That makes U.S. large caps look more attractive. What if we consolidate for a while, trend catches up to the index, now the distance from trend isn't as bad, and we maintain our momentum. So very reasonable, I think. Definitely a lot of opportunities throughout the year.
Yeah. And that forward cash return is particularly interesting because that's really what these numbers are getting to at the end of the day is attractiveness of the asset class relative to cash.
Yep.
And more importantly, attractiveness of the asset class relative to other asset classes out there available within client portfolios. So you take these two factors, blend them all together, U.S. large cap, excess return forecast over cash, 6% in isolation, not a whole lot of value to that number, but where does that rank or how does that compare to other areas of the market?
So where does it rank relative to history? It's in like the 66th percentile relative to history. So it's about what you should expect. And then turning that into an S&P 500 price target, because we know that's what people really want. If you think about a 10% return, your excess return plus your cash return, we're at about 6,000 on the S&P today, so that's 6,600. So a lot of other firms haven't yet released their outlooks or their price targets, but when they start to do so, we expect that's probably going to be reasonable. We're not saying this is an extreme outlook, so we would expect we'd get a lot of agreement out of that forecast. But like you said, what's even more important, what looks more attractive? Small cap stocks in the U.S. look more attractive. The exact same macro environment is slightly more favorable for smaller, more domestically focused firms. And we've been talking all year about how the valuations for small caps are attractive relative to large caps. So the macro factor for small value, for example, is around 3. Valuations are over 10. So now you're looking at 13% excess return over cash as your baseline. That's being compensated a little more than you historically would be. So they continue to look attractive. That's in line with the theme of the rotation continuing, so on and so forth. And on the negative side, foreign stocks. Valuations are great. Foreign currencies are cheap relative to the dollar. Foreign stocks in local currency terms are cheap relative to trend and all that. But it's not enough to offset the negative macro environment. This macro environment for domestic companies is pretty benign. For foreign companies, not benign, pretty negative. So we wouldn't, that's a potential opportunity throughout the year. If the macro environment starts to improve, foreign stocks look cheap, but we would want to wait for both of those to come together before we got really enthusiastic.
Yeah, absolutely. So kind of tying this all together, just quick summary, macro environment, okay, not going to blow anybody away, but not going to disappoint anybody. Valuation is going to be what's really driving the relative attractiveness of various asset classes as we get into 2025.
Yep.
And that will do it for this edition of the Outlook by STRAT. If you have any questions or comments, please feel free to reach out.